Hi, Sonali Sethna here in Pleasanton, California. Today we are going to meet the branch manager for RPM Mortgage, Todd Galde. So let's go ahead and talk to Todd. Hello, Todd. Good morning.
Sonali, how are you today?
Great. Nice
Awesome.
to see you.
It's great to see you.
Excellent.
What brings you in?
Well, I would like to ask you a few questions and
Okay.
just pick your brain about what the mortgage rates are doing.
Oh, absolutely.
So please go ahead and tell me, what do you think as far as these mortgage rates? Would they be, do you see them, are they going to be as low as they are, or can you tell me a little bit about it?
You bet. It's a great question. Everyone's asking it right now. I would say rates are going to stay relatively flat for probably the next 6 to 12 months. I think there's a lot of factors. 30 days ago, I would have said they're probably going to be rising very slowly over the course of this year. I think the issues in Cyprus, in North Korea right now are actually causing our markets to become a little more unstable in terms of where money is right now. And I don't know if you're familiar with how rates are derived, but the real simple explanation is there's two places that people have their money, investors: the bond market, which is safe, and the equities market or the stock market, which is volatile but more profitable, right? When things, for example, North Korea, right, and their admonition towards war, right, and or towards peace, wanting to send nuclear missiles our way,
Correct.
is causing a lot of investors to move money from the stock market into the bond market. Okay, when that happens, rates tend to come down. Okay, so for example, today we got 2 reprices for the better. Okay, even though the jobs market seems to be better, right? There's things here nationally and domestically that are promising for our economic environment, right, which would drive rates up. But internationally, okay, the instability overseas in Europe as well as in Asia are causing rates to come down. So for that reason, I don't think the international tensions are going to be resolved anytime soon. And so I see rates relatively flat for probably the rest of this year.
Oh,
Yeah.
great, great.
Yeah.
You answered it very well. Thank you very much. That definitely helps our clients. Moving forward, if you can explain the difference between conventional and jumbo loans.
You bet. It's real simple. So there's 3 tiers of pricing, okay, when it comes to loan amounts. The first one is what everybody knows is the conforming conventional loan amount, which is from 0 to 417,000.
Correct.
Okay, all of the rates that you hear advertised on the radio and on the television, all the 3 1/4, sub 3% rates, they're all based on that very low conforming loan amount. Okay, those rates are hovering right now in about the 3.5 to 3 3/4 range. A lot of it is dictated by credit, loan to value, right, job history, that type of thing. The second tier of pricing is between 417 and 625.5 in our market. Okay, so for example, the 9 counties that touch the Bay, okay, all have high cost loan amounts, which is 625,500. Okay, other areas of the nation don't have our high cost of living, and so their high end is much lower than that. Okay, those are the first 2 tiers of loan amounts, which are conventional conforming. Okay, the second one being what we call high balance conforming. The third one is jumbo. So anything over 625.5 up to literally 5 million and above is jumbo. Okay, the pricing between those 3 tiers is fluctuating between 1/4 to 3/8 in rate. So if you were promised 3.5% on a conforming loan amount, and you decide to kick up your loan amount for your purchase to above 417, you can expect to pay about 3 3/4 on a 30-year fixed rate. The jumbo would be about 3 7/8 to maybe 4%. Okay, so it's about 1/4% difference between the 3. Okay, now all of that is dependent on really solid credit, really solid job history, down payment amounts, right? All of those factors come into play.
Sure.
When pricing a loan.
Sure, that's great.
Okay.
FHA, I know
Yes.
they were really popular, and I know they're still popular, but just would like to get your, if you can kind of tell us, has the guidelines changed by FHA? I know there was some change that took place early April, or just, end of March, that's
Yeah.
what we heard, so if you can kind of touch base on that.
Absolutely. So FHA is obviously a government insured entity. that has significantly lower rates than conventional pricing. Okay, so for example, if your high balance 30-year fixed rate conventionally is 3 3/4, you're probably going to be able to get 3 1/4, maybe 3 3/8 with an FHA loan. So it sounds great, right?
Right.
When you're promised those types of rates.
Right.
The challenge is what we call mortgage insurance. Okay, right now mortgage insurance just went up on April 1st to 1.35. Okay,
Wow.
and that's on a typical 3.5% down, 30-year fixed. Right, it does fluctuate just slightly if you put more down, but for the most part it's going to be about 1.35, which is huge on a large loan amount. Right.
Sure.
So you basically have the blended rate, that you got your 3 1/4 or 3 3/8 plus the 1.25, right? That's a huge factor. Prior to April 1st, the MI, the mortgage insurance, was mandatory for 5 years. Okay, very few people knew that, right? Because they thought, well, I'll just call my bank in the next year or two when the equity, right? Because we're
Right.
seeing values go up so fast. I'll just call my bank and have the MI removed, right? I said, well, no, it's mandatory for 5 years. What? People don't know that.
Wow. Right.
As of April 1st, it's mandatory for 11 years.
Oh, wow.
Yes. So regardless of how fast values escalate over the next year or two, you're going to be stuck with that 1.35% for the next 11 years. Okay? So most people don't know that. Okay? I would never propose an FHA loan for a buyer for many reasons. You can put even less down conventionally. Okay? So MI or FHA requirements is 3.5% down. Okay? We can actually do 3% down on conventional.
Okay.
Now the requirements, you need a better credit score, right? You need good liquidity in the bank, right? But for the most part, you can do a 3% conventionally financed loan as opposed to an FHA loan. The other reasons I just don't like it is the 11-year restriction is just a huge handcuff for the buyer that they can't get out of unless they refinance the loan or sell the home over the course of the next couple of years. So I would not advocate an FHA loan for anyone at this time. I think the only reason FHA is worthy right now is for someone with credit challenges or even job history challenges, right? FHA is what I call new subprime. I mean, I would not put someone into an FHA loan today.
Wow,
So it
interesting.
might sound a little stern, but
Right, no, this definitely helps. I do have one question though. So the
Yeah.
buyers who are getting loans, FHA loans, is that something they can refinance within 6 to 9 months so they can get rid of that MI?
Yes.
How easy that is?
So here's the issue. It's easy. So refinancing out of an FHA loan is actually a lot of deals that we have going right now are getting people out of FHA loans into conventional loans with 90% or 95% loan to value. The one thing I wouldn't do so when you use an FHA loan, they have what's called an upfront mortgage insurance premium. Okay, it's 1.75 of the loan amount. So it's actual fee, okay, that FHA charges. So on a $500,000 loan, okay, you're going to pay roughly, what is that, roughly $8,500, okay, and that cost gets added to your loan amount, okay. So I've had people comment, well, once I refinance, I'm going to get a portion of that back, right? No, it is a cost.
Okay.
So if you have a $500,000 loan plus the $8,500 cost, that gets tacked onto the loan, right? So when you go to refinance, you're now refinancing $508,000, right? As opposed to just your original principal balance. But to answer your question, yes, it's not, it's no more challenging to refinance out of an FHA loan than anybody, in a similar situation who's already got an FHA loan.
Wonderful.
Yeah.
Well, that's great. So last question, what would be your advice for our buyers, today's buyers? With this crazy market with low inventory.
Absolutely. So first and foremost, before anybody comes to see you, or after they see you, we want to sit down with them as fast as possible, okay? Especially, I think, the very first question I would ask them is, are they self-employed, right? What does their income look like? Self-employment right now is very challenging, okay, for buyers. We put them through the ringer, and 3 years of tax returns. We've got to make sure there's no declining income. That's a huge red flag for investors right now.
Okay.
So for self-employed buyers, doesn't mean we can't do it. We do all the time, but it's much more stringent underwriting. Okay. So the first thing I would say when someone comes to you to look at a home is, you know, are you pre-qualified? Have you met with at least 2 or 3 loan agents, right? To get, you know, not just, you know, what, have you been rate shopping, right? Because rates are dependent on many, many factors, right? I would ask them, have you been qualified? Have you, you know, has a loan officer looked at your documentation?
Sure.
Right? Not just over the phone, okay? I just got an approval, literally a physical approval from a local, a large top 5 bank here in the Bay Area, and I called the buyer, and I said, okay, I'm looking at this pre-approval, and the numbers that you've shared with me don't pan out, and she made the comment, I never even sent them any documentation.
Oh, wow.
And I said, you've got to be kidding me. So we had a good conversation, she faxed over everything I requested, and then within 15, 20 minutes, I had an approval, a DU approval, okay, and then we actually are closing on the transaction in a couple weeks. So a lot of people are going by, you know, the verbal approvals, if you will.
Sure.
Yeah, because there's, you know, it's hard to get a loan done these days, and so I think a lot of loan officers are maybe over-promising and under-delivering right now.
Sure.
But, so that'd be the first thing I'd say, get your documentation in order, get it to someone who's qualified to assess the situation, and make sure you get that, not just a pre-qual letter, or even a pre-approval letter. I would get what's called a DU underwriting approval. And that's where all of the information is put into the Fannie Mae or Freddie Mac engine,
Okay.
and then it spits out whether or not we'll accept this loan.
Wonderful.
Yeah.
Great. Well, we really appreciate your time.
Absolutely, I hope this was
And
helpful for you.
Absolutely, definitely helps. Thank
Okay.
you very much.
Awesome.
And again, nice seeing you.
You bet.
Have
It's
a
great to
great
see
day.
you.
Thank
Awesome.
you.
Thank you.
Bye-bye.